Australia just became the undisputed king of the global lithium revolution. In 2024, Australian mines produced 86,000 metric tons of lithium. That's nearly half of the entire world's supply. But here's what nobody's telling you. This lithium boom isn't just about mining rocks, it's about controlling the future of transportation, energy storage, and the entire green energy transition. Every electric vehicle, every grid battery, every smartphone depends on this white gold. And right now, Western Australia is sitting on the most valuable mineral deposits on Earth. Think about this for a second. By 2040, the International Energy Agency expects lithium demand to explode to 40 times current levels if the world meets its climate goals. 40 times! That means every lithium mine operating today, every project under construction, every exploration site, all of it combined won't be enough. Australia isn't just riding a boom. Australia is positioning itself to dominate the most critical commodity of the 21st century. But there's a twist in this story that changes everything. While Australia mines more lithium than anyone else, China processes 98% of Australia's spodumene concentrate. That's right, Australia digs it up, ships it overseas, and watches other countries capture the massive value add from refining and battery manufacturing. The question keeping industry executives awake at night? Can Australia climb the value chain before it's too late? Or will the country remain forever locked as the world's quarry, while others profit from the lithium revolution? Let's start with the numbers that reveal just how massive this transformation has become. In 2023, Australia produced 86,000 metric tons of lithium, a staggering increase from less than 10,000 metric tons back in 2010. That's nearly a nine-fold expansion in just 13 years. Production projections show output climbing to 676 kilotons in lithium carbonate equivalent by fiscal year 2029. The growth trajectory isn't slowing down, it's accelerating. Western Australia's Pilbara region, traditionally known as the iron ore heartland, has transformed into lithium central. The geology here is extraordinary. Ancient pegmatite deposits containing spodumene, the lithium-bearing mineral that's become more valuable than gold. These aren't brine deposits like those in South America's lithium triangle. These are hard rock formations that allow immediate, reliable extraction without the water-intensive evaporation processes required for brine mining. The Greenbushes mine stands as the crown jewel of this lithium empire. Located 250 kilometers south of Perth in the sleepy town of Greenbushes, this operation has evolved from a modest tin mine dating back to 1888 into the largest hard rock lithium mine on the planet. Greenbushes produces approximately 1.95 million tons of lithium spodumene annually. To put that in perspective, at full capacity, this single mine could theoretically fulfill total global lithium demand by itself. The mine is owned by Talison Lithium, a joint venture between Chinese Tianqi Lithium Corporation, holding 51%, and Albemarle Corporation of the United States, holding 49%. This ownership structure reveals the geopolitical dimensions of the lithium race. Chinese and American interests collaborating and competing simultaneously in Western Australia. The geology at Greenbushes is genuinely world-class. The pegmatite deposit stretches over 3 kilometers long and up to 300 meters wide. The lithium zone contains spodumene that often comprises 50% of the rock. That's an extraordinarily high grade that makes extraction economically viable even during price downturns. The deposit is approximately 2,525 million years old, formed during the Archean age when tectonic forces created these mineral-rich intrusions. But Greenbushes is just the beginning. Pilbara Minerals operates the Pilgangoora mine, another massive lithium operation in the Pilbara. In fiscal year 2024, Pilbara Minerals produced approximately 725,000 dry metric tons of lithium spodumene concentrate. In fiscal 2025, production reached a record 754,600 tons, up 4% from the previous year. The company's expansion projects tell the story of ambition meeting geology. The P680 crushing and ore sorting facility, commissioned in August 2024, represents the largest lithium ore sorting facility in the world. With capacity exceeding 1,000 tons per hour, this plant uses advanced sensor-based technology from Pilbara Mining to identify and separate lithium-bearing ore from waste rock. The result? Production surged 77% in the June 2025 quarter compared to the March quarter, while unit operating costs fell 10%. The P1000 expansion project, completed in March 2025, added even more processing capacity. These brownfield expansions demonstrate how Australian miners are squeezing maximum production from existing operations before committing billions to greenfield developments. It's a calculated strategy. Prove the geology, optimize the processing, then scale up. And Pilbara Minerals isn't finished. The company announced a 1.2 billion Australian dollar plan to potentially double production capacity at Pilgangura. The P2000 project, currently in feasibility study stage, could deliver average annual production of 1.9 million tons of spodumene concentrate for the first 10 years. That would cement Pilbara Minerals' position as one of the world's largest independent lithium producers. Liontown Resources brought the Kathleen Valley mine online in July 2024, adding another major producer to Western Australia's lithium portfolio. The mine is expected to produce approximately 500,000 metric tons per year of spodumene concentrate by the end of Q1 2025, with an expansion planned in year 6 to bring production to 700,000 metric tons per year. The Australian federal government demonstrated its strategic commitment to lithium by extending a 230 million Australian dollar loan to support Kathleen Valley's development. But here's where the story takes a dramatic turn. All this production growth collided with brutal market reality in 2023 and 2024. Lithium prices crashed. After peaking above $80,000 per kilogram in late 2022, prices plummeted by approximately 87%. By the end of 2024, lithium carbonate prices had fallen to around $9,655 per ton. That's a catastrophic decline that threatened the entire industry's economics. What caused this spectacular price collapse? Oversupply. Excluding U.S. production, worldwide lithium production in 2024 increased by 18% to approximately 240,000 tons. Meanwhile, electric vehicle sales growth decelerated, not declining in absolute terms, but growing slower than the aggressive forecasts that had justified massive mining expansion. The result? A supply surplus that crushed prices and margins. Australia, accounting for 46% of global lithium production in 2024, felt this decline more sharply than most. The pain spread across the entire sector. Mineral Resources Ltd. halted lithium mine expansions despite high production volumes. Pilbara Minerals' gross profit witnessed a dramatic decline in 2024. Arcadium Lithium announced plans to place its Mount Cattlin hard rock operation into care and maintenance by mid-2025. Pilbara Minerals placed its Nunganju plant on care and maintenance in late 2024, lowering FY 2025 production guidance to 700,000 to 740,000 tons compared to previous guidance of 800,000 to 840,000 tons. The company's CEO explained the logic. During the 2018 to 2020 price downturn, multiple production cuts eventually signaled the market bottom. The Nunganju plant's closure in October 2020 marked the final cutback before prices recovered in 2021. History suggested pain precedes recovery. Core Lithium placed operations at the Finniss mine in Australia's Northern Territory on hold. Multiple projects delayed expansion plans or final investment decisions. The message from producers to the market was clear. Further supply cuts were essential to rebalance fundamentals. But here's the fascinating thing about commodity markets. Just when the pessimism reaches maximum intensity, the seeds of recovery begin sprouting. By late 2024 and into 2025, lithium prices started rebounding. By December 29, 2025, lithium carbonate prices had risen 56% from their January start position of $10,798.54 per metric ton to $16,882.63. What's driving this recovery? Several powerful forces converging simultaneously. First, the production cuts are working. Marginal mines shutting down, expansion deferrals, and mothballed operations are tightening available supply. Second, demand growth, while slower than the hyperbolic projections of 2021-2022, remains structurally strong. Prices for lithium-ion battery packs fell 20% in 2024, the largest drop since 2017. Lower battery costs make electric vehicles more affordable, accelerating adoption. In the United States, EV sales hit 11.4% of all vehicle sales in 2024, up from essentially zero in 2010. In China, EV sales exceeded 50% of vehicles sold in 2024. 50%! Think about that. More than half of all new cars sold in the world's largest automotive market are electric. The third demand driver, largely overlooked until recently, is energy storage systems. Grid-scale battery deployment is exploding. Energy storage is set to account for approximately 25% of total global battery demand in 2025, with growth of about 44% expected. In the United States specifically, storage could represent 35 to 40% of battery demand in the next few years. Why is energy storage booming? Because renewable energy, solar and wind, is intermittent. When the sun doesn't shine and the wind doesn't blow, batteries provide the storage that makes renewable energy reliable. As solar and wind deployment accelerates globally, battery storage becomes essential infrastructure. And unlike electric vehicles where consumer purchasing decisions drive demand, grid storage is driven by utility-scale investment and government mandates. The International Energy Agency's latest demand outlook shows that electric vehicles now account for nearly 90% of lithium demand. Batteries are projected to account for 94% of total lithium demand by 2030. Everything else, ceramics, glass, lubricating greases, medical applications, represents just 6% of the market. The lithium story is the battery story. Fast Markets projects that the lithium market will shift from a small surplus in 2025 to a deficit of 1,500 tons lithium carbonate equivalent by 2026. Industry analysts from Ganfeng Lithium suggest that if demand growth reaches 30 to 40% by 2026, prices could climb to 150,000 to 200,000 yuan per ton. That's roughly $21,000 to $28,000 per ton, nearly double the late 2025 price levels. Now, here's the strategic challenge that defines Australia's lithium future. Mining is the easy part. Australia has world-class geology, established mining expertise, supportive regulatory frameworks, and abundant land. But mining raw spodumene concentrate captures only a fraction of the total value chain. The real money is in refining lithium hydroxide and lithium carbonate, the battery-grade chemicals that manufacturers actually use. Currently, about 98% of Australia's spodumene concentrate is exported for processing, mostly to China. China accounts for 70% of global lithium refining, according to the International Energy Agency. This creates a strategic vulnerability. Australia controls the raw material, but depends on Chinese processing capacity to realize its value. The economic implications are massive. Spodumene concentrate might sell for $700 to $1,000 per ton, but battery-grade lithium hydroxide commands 10 to 20 times that price. By exporting raw concentrate, Australia leaves billions of dollars of value on the table, while simultaneously creating dependency on foreign processing. The good news? Australia is finally waking up to this reality. Albemarle operates a lithium hydroxide refinery at Kemerton in Western Australia. Tianqi's Kwinana refinery, located 250 kilometers north of Greenbushes, is undergoing commissioning with total capacity of 48,000 tons per annum. This facility represents Australia's first fully automated battery-grade lithium hydroxide manufacturing plant outside mainland China. Covalent Lithium is constructing another lithium refinery in Western Australia. These projects signal a strategic pivot from being purely an exporter of raw materials to developing domestic value-added processing. It's the same transformation that oil-producing nations underwent when they developed domestic refining capacity rather than just exporting crude. But building refineries requires enormous capital investment, sophisticated technical expertise, access to chemicals and energy, environmental approvals, and guaranteed feedstock supply. It's vastly more complex than mining. Chinese companies spent decades developing their refining capabilities. Australia is trying to compress that learning curve into just a few years. The technological dimension adds another layer of complexity. Lithium extraction from spodumene requires roasting the mineral at high temperatures, then chemical processing to produce lithium hydroxide or carbonate. The chemistry is well understood, but optimizing yield, purity, and cost-effectiveness requires extensive operational experience. Australian refineries must compete against established Chinese producers who've achieved economies of scale and process optimization. There's also the downstream integration question. Should Australian refineries sell lithium chemicals to global battery manufacturers, or should Australia go even further, establishing domestic battery cell production and potentially even electric vehicle manufacturing? Each step up the value chain captures more value, but requires exponentially more capital and expertise. Governments are stepping in with strategic support. The $230 million loan to Liontown Resources demonstrates federal commitment. Western Australia's state government has invested heavily in industrial infrastructure, power supply, and port facilities to support the lithium sector. These aren't just mining subsidies, they're strategic industrial policy aimed at building comprehensive supply chains. The geopolitical dimensions can't be ignored. The United States, European Union, Japan, and South Korea are all desperate to reduce dependency on Chinese battery supply chains. Australia's geographic position, political alliance with Western democracies, stable regulatory environment, and abundant lithium resources make it an ideal strategic partner. In October 2025, the U.S. government announced a 5% stake in Lithium Americas and its Thacker Pass project. Oil majors like Chevron and ExxonMobil are acquiring lithium acreage in the Smackover Formation, spanning Florida to Texas. These investments demonstrate that lithium has transcended commodity status. It's now a strategic resource on par with oil or semiconductors. For Australia, this creates opportunity. Long-term offtake agreements with allied nations, joint ventures bringing foreign capital and expertise, technology partnerships, guaranteed market access that insulates Australian producers from Chinese demand volatility. The lithium boom could reshape Australia's economic and strategic positioning for decades. But let's talk about the environmental and social challenges that accompany this boom. Hard rock lithium mining involves blasting, crushing, and processing massive quantities of rock. Energy consumption is substantial. Water usage, while far less than brine extraction, still requires careful management in water-scarce regions. Tailings dams, waste rock piles, dust generation all present environmental challenges. At Greenbushes, local residents have raised concerns about dust pollution, with official records showing the mine exceeded regulated safe dust limits at least 8 times in 2024, with 4 additional violations in early 2025. Air quality monitoring showed particulate matter PM10 levels reaching 120 micrograms per cubic meter, double Western Australia's regulatory limit of 60 micrograms per cubic meter. These aren't abstract environmental concerns. They're quality of life issues for people living near mining operations. Light pollution from 24/7 operations, noise from blasting and heavy equipment, truck traffic through small towns. The social license to operate requires mining companies to address these impacts. Talison Lithium at Greenbushes has committed substantial community investment, but tensions persist between economic benefits and environmental costs. Indigenous Australian communities hold native title rights over vast areas where lithium deposits exist. Mining agreements must respect cultural heritage, provide economic opportunities, ensure environmental protection, and honor traditional land relations. When done properly, these partnerships create mutual benefits. When done poorly, they generate conflict and legal challenges that can halt projects. The labor dimension presents both opportunity and challenge. Lithium mines create high-paying jobs in regional areas where economic opportunities are often limited. Fly-in, fly-out workers support families and communities. Local businesses benefit from mining-related demand. But the cyclical nature of commodity markets means boom periods alternate with busts. Workers hired during expansion face potential layoffs during contractions. Fast Markets research forecasts that the global lithium market recorded a surplus of 137,500 tons in lithium carbonate equivalent basis in 2024, following a 175,700 ton LCE surplus in 2023. The market is expected to experience surpluses until 2027. This extended period of oversupply creates sustained pressure on prices and margins. For mining companies, this means brutal cost discipline, deferring expansions until demand catches up, optimizing existing operations to reduce unit costs, maintaining financial flexibility to weather prolonged downturns. The companies that survive and thrive will be those with low-cost operations, strong balance sheets, and patient capital. Pilbara Minerals' fiscal 2025 revenue was $769 million Australian dollars, falling almost 39% short of last year's $1.25 million. Underlying EBITDA saw a significant decrease, down 83% at $97 million. Despite the revenue collapse, CEO Dale Henderson emphasized that our balance sheet remains robust, with approximately $1 billion in cash and $1.6 billion in total liquidity. This financial resilience matters enormously. Companies with weak balance sheets face forced asset sales, equity dilutions, or bankruptcy during downturns. Those with strong cash positions can not only survive, but potentially acquire distressed assets at bargain prices. The lithium downturn of 2023 to 2025 will likely trigger industry consolidation as stronger players absorb weaker ones. Rio Tinto's proposed $6.7 billion acquisition of Arcadium Lithium demonstrates this dynamic. Despite current market difficulties, Rio Tinto believes lithium will enter deficit by decade's end and is positioning accordingly. The mining giant understands that commodity cycles are inevitable. Buying assets during downturns often proves more profitable than building during booms. Technology innovation offers pathways to competitive advantage. Tomra Mining's sensor-based sorting technology at Pilbara enables early waste rejection, significantly improving lithium recovery and final product quality, while reducing energy consumption by 8 to 15 gigawatt-hours annually. These efficiency gains directly impact unit costs and environmental footprint. Automation and artificial intelligence are transforming mining operations. Autonomous haulage systems, remote operation centers, predictive maintenance using machine learning, digital twins of processing plants all contribute to productivity improvements. Australian mining companies, with their technical sophistication and access to capital, are well positioned to deploy these technologies. The chemistry of batteries is also evolving. Lithium iron phosphate batteries, or LFP, are gaining market share versus nickel manganese cobalt chemistry. LFP batteries use less nickel and cobalt, but more lithium per kilowatt-hour of capacity. This shift actually increases lithium intensity in the battery market. But alternatives to lithium-ion technology exist. Sodium-ion batteries, developed by CATL and other Chinese manufacturers, could potentially replace up to 50% of the LFP market, according to some projections. Sodium is far more abundant and cheaper than lithium. If sodium-ion technology achieves comparable performance, it could disrupt lithium demand. The International Energy Agency suggests sodium-ion is most competitive when lithium prices are high. At current low prices, lithium maintains its advantage. This creates an interesting dynamic. Lithium's price collapse might actually protect its market dominance by making alternatives less economically attractive. Solid-state batteries represent another potential disruption. These next-generation batteries promise higher energy density, faster charging, and improved safety compared to conventional lithium-ion, but they also require lithium, often in different chemical forms. The timeline for commercial solid-state battery production remains uncertain, likely mid-2030s at earliest for mass deployment. Direct lithium extraction technology, or DLE, could reshape lithium production. Traditional brine extraction requires evaporation ponds covering vast areas, taking 18 to 24 months. DLE uses chemical or electrochemical processes to extract lithium in hours or days with far less water consumption. If DLE proves economically viable at scale, it could unlock massive brine resources in places like the Smackover Formation in Arkansas. For Australian hard rock producers, DLE represents both threat and opportunity. Threat because it could add supply from brine deposits previously considered uneconomic. Opportunity because DLE could be applied to process previously stockpiled waste or low-grade material at existing Australian operations. The recycling dimension will become increasingly important. As the first generation of EV batteries reaches end of life in the late 2020s and 2030s, substantial lithium recovery from recycling becomes feasible. Battery recycling could eventually supply 15 to 20% of lithium demand, reducing pressure on primary mining. Australia has the opportunity to develop domestic battery recycling capabilities, capturing value from used batteries while reducing mining requirements. Let's talk about the investment perspective. Lithium stocks experienced extraordinary volatility. After years of underperformance, lithium equities surged in the second half of 2025, with year-to-date gains averaging 47%. This rebound closely tracked rising spot prices, demonstrating how tightly lithium equity valuations correlate with commodity prices. For investors, lithium presents classic commodity exposure: extreme cyclicality, leverage to economic growth, sensitivity to technological disruption, geopolitical considerations, and environmental, social, and governance factors. The sector rewards those who can correctly time the cycle, identify the lowest-cost producers, and maintain conviction through volatility. Exploration activity tells its own story. Lithium exploration budgets in 2025 were absolutely gutted, falling to roughly half of 2024 levels. This decline reflects depressed prices and the completion of late-stage programs. But cyclically, reduced exploration today creates supply constraints tomorrow. When prices inevitably recover, there will be fewer advanced projects ready to fill demand growth. The pipeline of new lithium projects globally faces challenges. Long lead times from discovery to production, often 7 to 10 years, environmental permitting increasingly difficult in many jurisdictions, capital costs escalating due to inflation and supply chain constraints, community opposition in some regions. These friction points mean that even when lithium prices rise, supply response isn't immediate. The International Energy Agency projects that lithium demand from electric vehicles and energy storage systems will rise significantly, with EV adoption making up more than 50% of lithium demand in 2024. The IEA expects this proportion to increase to approximately 75% of total demand by 2030. Global EV sales grew from 3 million units in 2020 to almost 17 million units in 2024, a compound annual growth rate of nearly 50%. This sustained momentum in EV adoption, despite current market challenges, underscores the structural nature of the lithium demand story. Government mandates in Europe, aggressive targets in China, state-level policies in the United States all point towards continued electrification of transportation. The pace might fluctuate year to year, but the direction is unmistakable. Energy storage deployment follows a similar trajectory. Bloomberg NEF forecasts that global energy storage installations will reach a cumulative 411 gigawatts, or 1,194 gigawatt-hours of storage, online by the end of 2030, representing a 15-fold increase from the 27 gigawatts, or 56 gigawatt-hours, of storage online at end of 2021. That's exponential growth driven by renewable energy build-out. The cost declines enabling this growth are remarkable. The total installed cost of utility-scale solar generation, including battery storage, was $5.54 per kilowatt-hour in 2009. By 2023, that had dropped to $0.68, and initial data suggests costs may have fallen an additional 20% in 2024. That's close to a 90% decline in 15 years. As storage costs continue falling, deployment accelerates. As deployment accelerates, lithium demand grows. As demand grows, eventually supply tightens and prices recover. Understanding these interconnected dynamics is essential to grasping where the lithium market is heading. Australia's position in this future depends on strategic choices made now. Will the country invest in refining capacity to capture value add? Will environmental and social challenges be managed responsibly to maintain social license? Will technological innovation keep Australian operations cost competitive? Will trade relationships with key markets remain stable? Will capital flow to projects that balance economic return with sustainability? The Greenbushes mine expansion plans illustrate these considerations. Talison Lithium is pursuing capacity expansion projects requiring substantial environmental approvals. The proposal would increase the development envelope from 2,207 hectares to 2,826 hectares, a 28% increase, requiring additional clearing of 191 hectares. Balancing production growth with environmental protection requires careful planning and community consultation. IGO announced revised budget and timeline for the chemical-grade Plant 3 project at Greenbushes, with total cost rising to $880 million Australian dollars, up from previous estimates of $500 to $550 million. First ore from CGP3 is now expected in the second quarter of fiscal year 2026, delayed from early 2025. Cost overruns and schedule delays reflect the complexity of building sophisticated processing facilities. But when complete, CGP3 will add approximately 500,000 tons per year of additional spodumene concentrate production capacity. This incremental supply positions Greenbushes to maintain its status as the world's premier lithium operation well into the 2030s. The competitive landscape is intensifying. Chinese firms are expanding their influence through partnerships and offtake agreements, controlling lithium at every level, starting at the source. This supply chain control benefits Chinese EV battery makers like BYD and CATL, who can secure feedstock at favorable terms. Some analysts suggest China could overtake Australia in lithium processing capacity by 2026, though Australia maintains the lead in raw mine production. China's edge lies in refining infrastructure, not resource endowment. This creates both threat and opportunity for Australia. Threat of value capture by foreign processors, opportunity to develop domestic capabilities. The lithium market's path forward involves navigating multiple crosscurrents: structural demand growth from electrification, cyclical oversupply from aggressive expansion, technological disruption from battery chemistry evolution, geopolitical competition over strategic supply chains, environmental imperatives for sustainable production, economic pressures for cost competitiveness. Australian miners, investors, policymakers, and communities must grapple with all these dimensions simultaneously. There's no simple playbook. The companies and jurisdictions that succeed will be those that balance multiple priorities: economic viability, environmental responsibility, technological innovation, and strategic positioning. What's absolutely certain? Lithium is not just another commodity boom and bust cycle. This mineral has become foundational to the global energy transition. Every government committed to net zero emissions needs massive quantities of lithium. Every automaker transitioning to electric vehicles depends on lithium batteries. Every utility building renewable energy plus storage infrastructure requires lithium. Australia's 86,000 metric tons of production in 2024 represents just the beginning. With production projected to reach 676 kilotons by fiscal 2029, Australia is doubling down on its lithium dominance. The Pilbara, Greenbushes, Kathleen Valley, these aren't just mine names, they're the foundations of the electric vehicle revolution. The price volatility of recent years? That's growing pains, not death throes. Every transformative industry experiences boom-bust cycles during rapid growth. Oil in the early 20th century, semiconductors in the 1980s and 1990s, solar panels in the 2000s, lithium in the 2020s follows the same pattern: explosive growth creating oversupply, followed by consolidation, followed by the next wave of expansion. Investors who understand commodity cycles recognize that the best time to position in an industry is when prices are depressed and pessimism is maximum. Lithium in late 2024 and early 2025 presented exactly that opportunity. As prices rebound through 2025 and into 2026, those who maintained conviction during the downturn will be rewarded. For everyday Australians, the lithium boom represents economic opportunity: high-paying mining jobs in regional areas, royalty revenues funding public services, export earnings strengthening the national economy, technology development and industrial capacity building. Australia can leverage its natural resource advantage to build comprehensive lithium industries that go far beyond just digging ore. The environmental and social challenges are real and must be addressed. Dust pollution, water usage, land disturbance, community impacts, none of these should be dismissed or minimized. Mining companies must earn and maintain their social license through responsible operations, genuine community engagement, environmental stewardship, and transparent communication. But the alternative to Australian lithium isn't no lithium. It's lithium from jurisdictions with weaker environmental standards, less community consultation, lower labor protections, and more opaque governance. Global lithium demand will be met by someone. Australia has the opportunity to set the standard for responsible lithium production. The future of electric vehicles is the future of lithium. The future of grid storage is the future of lithium. The future of portable electronics is the future of lithium. And right now, the future of lithium runs through Western Australia. From the Greenbushes pegmatites formed 2.5 billion years ago to the ultra-modern Tomra sorting facilities at Pilbara, from hard rock spodumene extraction to battery-grade hydroxide refining, from exploration tenements in the outback to offtake agreements with global battery makers, Australia's lithium story encompasses geology, technology, economics, geopolitics, and environmental stewardship. The question for the next decade? Will Australia capture the full value of its lithium resources by building downstream capabilities, or will it remain primarily an exporter of raw materials? The answer will determine whether lithium drives broad-based industrial development or remains a classic resource extractive play. Either way, one thing is absolutely clear. Australia's lithium mining boom isn't a temporary phenomenon. It's a structural transformation driven by the inexorable shift toward electrification. As long as the world pursues decarbonization, electric mobility, and renewable energy storage, lithium demand will grow. And as long as lithium demand grows, Australia's world-class deposits will remain central to global supply. The Western Australian mines operating today are just the first generation. New projects in development, exploration programs discovering additional deposits, technology improvements enhancing recovery, all point to decades of lithium production ahead. Australia isn't just riding a boom. Australia is building an industry that will define the global energy landscape for generations. The electric vehicle revolution needs lithium. Grid storage transformation needs lithium. Consumer electronics evolution needs lithium. And the world needs Australia to supply that lithium responsibly, efficiently, and sustainably. That's the opportunity. That's the challenge. That's the future being built right now in the Pilbara, at Greenbushes, at Kathleen Valley, and across Western Australia's lithium fields. This is Australia's lithium moment, the white gold rush of the 21st century, the resource that powers the green energy transition. From 86,000 metric tons today to potentially doubling that within 5 years. From raw ore export to domestic refining, from commodity supplier to strategic partner in global battery supply chains. The lithium mining boom in Australia isn't just about rocks and revenues, it's about positioning for the future. A future where every car is electric, every grid is backed by batteries, and every smartphone depends on lithium chemistry. Australia has the geology, the expertise, the capital, and the strategic relationships to dominate this space. The only question is whether the country has the vision and commitment to capture the full potential. Welcome to the lithium revolution. Welcome to Australia's electric future.